Traders, there are thousands and thousands of strategies. So how do you know which one is right for you? Well, let me help you because I'm going to test some of the most watched, some of the most viewed, some of the most liked, some of the highest win rate strategies there are right now in the markets. And I'm going to put these strategies through their paces, test them in the live markets so you know exactly what they are made of. And then you can decide if it's right for you. This week in the series, we are going to check out this MACD strategy. And as you can see, it's the best MACD trading strategy with an 86% win rate. Okay. It's got over or almost 4 million views and over 4,000 comments. There are lots of people trading this strategy. But is it any good? So later on in the vid, guys, we are going to test this in the live markets and share all the results with you and how we've tweaked it to make it even better. But before we do any of that, we need to understand the strategy. So let's dive into this video right now.
This MACD strategy I'm about to show you is one of the highest win rate strategies you can possibly do in trading. It is very easy to use, works in almost every single market, and most importantly, it makes money. Well, enough talk, let's get straight into it. The MACD, or the moving average convergence divergence, is one of the most popular technical indicators used by traders. Essentially, this indicator uses moving averages to find trends in the market, and it's pretty damn good at it too. Now, if you're an experienced trader, you've probably used or heard about this MACD indicator before, but the MACD indicator by itself is just alright, to be honest. So make sure you watch this full video to see how I pair it with some other indicators to make it perform so much better. First things first, let's add the MACD indicator to our chart. To do that, you're going to go to TradingView or whatever chart website you prefer, and then you're going to go up here to the Indicators tab, type in MACD, and click this top one. Now that we have the MACD indicator added, let's make sure we know how the MACD actually works. The MACD is made up of 4 different components: the MACD line, the signal line, the histogram, and the zero line. The MACD line, which is the blue line, in most cases is usually a 12-day moving average. The signal line, which is the orange line, is usually a 26-day moving average. Next, we have the histogram, which represents the difference between the MACD line and the signal line. So, for example, the smaller the space between the two lines, the smaller the histogram gets. The bigger the space, the bigger it gets. You can also see once the MACD line crosses above the signal line, the histogram turns green, and if the MACD line crosses below the signal line, it turns red. And finally, we have the zero line, which basically represents the center of the MACD indicator. Now that we know the 4 components, let's make sure we know how to use them. The MACD indicator is insanely good at finding trends in markets. How you can tell if a chart is about to have an upward trend is by looking for a cross upwards between the MACD line and the signal line. For example, here the MACD crosses above the signal line, indicating the chart is in an upward momentum. And here the MACD crosses below the signal line, indicating it's in a downward momentum. You can also use the histogram to indicate how much momentum there actually is. So if the histogram is getting bigger, that means there is an increase in momentum. If it's getting smaller, there's a decrease in momentum. So how you actually want to use this indicator is by when the line crosses upwards, but only if they cross below the zero line. If they cross and it's above the zero line, you wouldn't want to enter the trade. It's the same concept with shorting. You only want to enter a short trade if the lines are crossing downward and it's above the zero line. So as you can see just by watching this indicator is extremely easy to use. But the problem most traders encounter is that they only use this indicator by itself. Let me tell you why this doesn't work. The MACD indicator works extremely well if the market is in a trend. So for example here, the MACD indicator is doing a great job indicating when the price is about to move upward because the chart is in an upward trend. But here the price is in a downward trend, but the MACD is still signaling to buy long even though the price is going down. A simple fix to this issue, for example, if we're trading long, we only want to trade if the market is in an uptrend. You never want to trade against the trend because the odds will always be against you. So an easy way to figure out if the market is in an uptrend, you simply just need to add a 200-day moving average. To do this, you're going to go to the Indicators tab on TradingView and type in EMA, which stands for Exponential Moving Average or Moving Average Exponential. Click the top one. Then you're going to go here, click the settings of the EMA, and you're going to go to inputs and change the length to 200, which is going to make it a 200 exponential moving average. Then you're going to go to style, and I like to make mine red, but you can make it whatever color you want. Once we have the EMA indicator added, you'll see just a single line. If the price is above that line, the market is in an uptrend. If the price is below that line, the market is in a downtrend. So after learning that we only want to trade in an uptrend market if we're going long, so all we have to do is put it all together. We buy if the MACD line crosses below the 0 line mark and the current price also is above the 200-day moving average. This will guarantee that you are only trading when the market is in an uptrend, which is a very powerful combo. If you wanted to short, you would do the exact opposite. So make sure the price is below the 200-day moving average and the MACD lines are crossing downward above the 0 line. So as an example, we would want to enter a long trade right here because the MACD lines are crossing upwards below the 0 line and the current price is above the 200-day moving average. Now what I like to do is set a stop loss below the 200-day moving average, so the 200-day almost acts as a wall that the price has to break through to hit the stop loss. Then I like to have a 1.5 profit ratio for my profit target mark. So as you can see for this example, the strategy worked exactly as we wanted it to, and we made money.
All right, guys, I'm going to stop it there because we've got the idea of the strategy, right? We're going to use the MACD and we're going to use the 200 exponential moving average. There's also a couple of other tweaks that we're going to make, guys, and I'm going to share all of this and what we found in the live markets right now. Before I do, guys, please don't forget to subscribe to the channel, smash the notification button, and please smash that like button. If you haven't already, please come join our free trading community. We've got a free Discord channel. Come join it. Enjoy yourself. We also have premium trading education, guys, on our website. So please go to www.simply-forex.com and get access to all of that. All the information is in the video description. Also, guys, please don't forget to leave a comment because that really supports the vid as well. Right, let's see this strategy right now in the live markets. So as with a lot of these online strategies, they make these claims of 86% win rate, and they also make it look so easy to trade it, and it's so easy when to enter. But obviously, there's always some grey area there, and the win percentages are not always as what they claim. Now, this strategy, the results are going to surprise you. And what we're looking at is Euro US dollar, and we're trading the 15-minute chart, okay? They traded the 15-minute chart, so are we. But then we also back tested across a few currency pairs, and Euro US dollar seemed to work the best. And that was on about 3 months of back testing. And we'll share all of this with you. I'm going to actually take you through every trade in October so that it's crystal clear. All right. Now, we have made a couple of tweaks to the strategy. Right now, the first tweak is that our risk to reward is going to be 1:1. They were doing 1:1.5, but we're going to do 1:1. And their stop loss was also above or below the exponential moving average 200. Okay, but what we're going to do is we're going to put our stop loss. Okay, so let's write this down: 5 pips above or below the last M15 swing high or low. Okay, so the swing low if we're buying, swing high if we're selling. But we'll make this all clear, guys, right? So this is the M15 chart. This was the first trade that I come across. So remember, we are above the exponential moving to 200. So we're looking for buys. Okay, we had below the 0 MACD level, we had a crossover once, and we had a crossover again. So technically we had 2 trades here, and this is represented by these 2 here. Now, would you enter this again if you were in a trade? Yeah, I would suggest yes, you can, long as you keep with your money and risk management. So the first trade, we get the crossover here. It's not until this candle that we can actually enter. We enter here, we put our stop loss 5 pips below the low here, the M15 low, and we're looking for 1:1. Okay, there we go, 1 out of 1, good trade. Okay, again, we get a setup here as well. All right, so we can't enter, we can only enter, guys, when this blue line has fully left and moved away from the orange line. That is a clear crossover for me. And that doesn't happen until this candle right here. Then we can enter. This is the last low, 5 pips below the last swing low, and we take 1:1. So far, guys, so good, right? 2 out of 2. If we carry along now, I've put arrows in spots where things are not necessarily clear because we get this crossover below here. And if I pull out my pointer, right, you can see that we actually get a get my teeth in. We actually get a signal right here on this candle right here. Okay. Now, this candle is technically above the 200 EMA when it closes, but do you really want to take that trade? The answer is no. Okay, and there's some rules we've made for this strategy as well. So if it's touching, the candle is touching the EMA, then it's a no. Or it's very close to the EMA, it's a no. We have the same thing here, guys, right? So we get our crossover, okay, right here. And on this candle right here, we technically are trading below the exponential moving average 200. But again, do you really want to take that trade so close to the EMA? No. So that goes back to my point, guys. It's not always crystal clear or how they make it seem in the video. You're going to have a little bit of ambiguity with trades like this. But we need to see price move away from the moving average quite clearly, and the candle cannot close on the EMA. All right, so these two were not trades for me. But we carry on, guys. Okay, now again, okay, we're below the exponential moving average 200, right? We get our crossover right here. We actually get it on this candle right here, and that's clearly below the exponential moving average, right? And then we take profit. Okay, start selling here, stops 5 pips above that high, and we take 1:1. Now, this is a very good example of why we take 1:1. If we actually waited for 1:1.5, this trade would have been unsuccessful. Okay, and making our risk to reward 1:1 will actually give us a better win rate. And if you didn't take it at 1:1, eventually we would have got stopped out up here. All right, so another successful trade. Again, guys, we get another one, right? So we're below the exponential moving average. We're above the 0 line. We get a crossover right here. All right. Now, again, if I do my line, you can see that candle right there is where the moving average moves away. Okay, you can see at that candle right there, it becomes a clear cross. So we enter there, stop loss 5 pips above the high. Okay, take 1:1. This is another example where you might not have quite have got 1:1.5. And interestingly, right, you don't get, this is another nice trade, right? So it's doing so well. We have 100% record so far. Okay, let's carry on. Now, this one is interesting, guys, right? Because we're clearly below the exponential moving, 200. Okay, the candle is pointing out this level because at this point you get a crossover here, but it's literally at the 0 line when that happens. So for that reason, that is not a trade. It's just at the 0. Remember, we want to be below the 0. All right, so no trade there. If we carry on, we get another trade here. Okay. Now, again, this has come from above to below, but it's clearly below, and we have a candle that's closed below it. Okay. You can see we get the crossover on that candle right there. So I think this is a valid trade. The candle has closed below the moving average 200, stopped above the high. We get our 1:1. Okay, nice trade. Again here, when we get the crossover here, right? So we've got our crossover here. Okay, there's the line. Now, that candle right there is where we get the cross down here. And again, as I said, the candle needs to have clearly left the exponential moving 200, and it hasn't. So no trade. Okay, so remember that rule, guys. That will keep you out of trouble. Another one right here. Okay, so we get our crossover. We're above the 200. We get our crossover right here, below the 0, which is what we want. If you can see, I line up the candles. It's actually this one here that we enter on. And again, put our stop loss 5 pips below the low, or even that low, it would have been fine. We make 1:1. Okay. Now, one idea here is, guys, you could, leave some money on the trade, right? So once you take your 1:1, potentially close 80% of the trade here, right? Or 70%, and then let 20% run. Okay, so that's another idea. You can add that to your strategy. Again, there's a few, not sure ones. We're above the 200, but the crossover is at the 0. Again, here we're above the 200. The crossover is at the 0, right? So no trade. This one is our first losing trade. And, and even then I had to sort of force a losing trade. Because again, right, we are below the 200. Okay, when we get our crossover here, we're above the 0. Okay, and we want to come down, right? So we're below the 200. This is above the 0. We get our crossover with this candle right here. Clearly closed below the exponential 200. Nice trade. Now, I put my stop 5 pips above that high. Now, whether we actually hit our target there because of spread, maybe not. So I said this was a losing trade. Just because we had so few of them with all of our back testing, I had to be a little bit harsh. And we're just going to carry on, guys, right? Because I'm going to get you to the results now. But another winning trade, right? So nice trade here. Another winning trade up here. Okay, tick. Another winning trade up here when we crossed here. Candle here. Sorry, so bear with me with this one, guys. This was a winning trade. You're probably thinking, Tom, it didn't hit target. But because we put our stop loss above this swing high, right? Our stop loss was here. We didn't actually get hit. Okay, and price come down eventually. Right, and now we're back at, the start of October, and we didn't actually have any trades there. So for the month of October, guys, this strategy was excellent. Okay, we actually had 10 trades, 9 were winners, and we had 1 losing trade. That is a win percentage for October of 90%. And we actually back tested this over 3 months, okay, on Euro US dollar, on the M15 chart, and it come back with a win percentage of 78%. So this is a very good strategy. Please remember the tweaks that we made with regards to risk to rewards and stop losses. And also remember, this is only for Euro US dollar and on the M15 chart. What I suggest is you do your own back testing, guys, or you can come join our free trading community and check out all our results yourself. The link is in the video description. So there you go, guys. A super robust strategy. If you've enjoyed the vid, please don't forget to subscribe to the channel, smash the notification button, and smash that like button. And I'll see you all again soon.